Good evening, everyone, and welcome to our session for today. So today we'll be looking at trading stocks or how to trade shares of companies which are listed. So these companies are available on our trading platform, and most of them happen to be international companies. So when you talk of stocks, stocks are units of ownership in a company which is listed in an exchange. So stocks are also known as equities. So traders transact stocks in units called shares. So your holding or your stakeholding within a company is measured by the number of shares that you hold in that company. So a share is the smallest unit of ownership in a company, and it entitles a trader a proportion of the corporation's assets and profits equivalent to the amount of stocks that they hold. So for those people who trade physical shares, not only do they get value as the value of the company fluctuates, but they can also generate money through dividends. So dividends happens to be part of the profit that is allocated back to the shareholders. So a company must go through an IPO in order to have its shares publicly traded. So IPO basically means initial public offering, and this is the process of offering shares of a private corporation to the public to own part of the company. So private investors want to fully realize gains from the investments by allowing public investors to participate in the offering. So what does EGM Securities offer? Or what can you be able to trade from EGM Securities platforms? So the company offers contracts for difference. So shares can be traded either as contracts for difference or they can be traded as physical stocks. So a contract for difference is a financial contract between a trader and a broker, and it allows the trader to exchange the difference between the market value of the underlying stock when the contract is opened and the value when the contract is closed. So it's just an agreement between the broker and the trader that the trader will hold a position in the stock. Then the difference between the amount the trader spends to either buy or sell a particular stock and the price at which the trader will liquidate the contract at. So that difference is what determines whether the trader will make a profit or he will make a loss upon deciding to close the trade. So the differences in the settlement between the opening and the closing trading price is cash settled. So contracts for difference provide a unique opportunity to trade by predicting price movements in the market without owning the underlying asset. So one of the main difference between physical stocks and contracts for difference is that physical stocks entitles a trader to own those shares or stocks. However, contracts for difference, the trader does not own. He basically holds a position, but the asset there or the underlying asset is not owned by the trader. So you can now have a look at the differences between contracts for difference and physical stocks. So with contracts for difference, shareholder does not own part of the company. However, if the trader is trading stocks in an exchange or physical stocks which are traded in a stock exchange, then the trader would own those shares. The other difference is that you can trade both a long position, which is a buy, or a short position, which is a sell, when you're trading a contracts for difference. And this is one of the main advantages of trading contracts for difference. You'll have a chance to capitalize on opportunities whichever way the market price goes. If the price is going higher, you can buy, or when the price is continuously declining, you can also sell and realize a profit. If you're trading physical stocks, you can only benefit on one side. So you can only buy when the price is low, anticipating to create value once the price rises. Then the other difference between contracts for difference and physical stocks is that contracts for difference entitle, or they do not offer the trader or the investor the right to vote. And again, remember, contracts for difference are traded over the counter. So they are traded online. When it comes to physical stocks, when the shareholder attends an annual general meeting, or maybe an extraordinary general meeting, they have the right to vote. Then the final difference between these two is that contracts for difference are leveraged, but physical stocks are not leveraged. So when it comes to leverage, it's where a trader would contribute a percentage or a portion of the amount that is required to open a position. So if, for example, for you to open a position, you'd require, let's say, 1,200, and maybe you're provided a leverage of 1:400, then it means that you'd require around $3 to open that position. So when you're offered a leverage, the amount of margin or the requirement that would enable you, or the amount of capital that would be required to open that position is quite low when the leverage is high. So which stocks can a trader access on EGM Securities platforms? So we have over 1,700 US companies. So when it comes to US companies, a trader can trade a minimum of one stock. Then for each contract, they can trade as many as 300 shares per contract. Then when it comes to the cost of trading, you will be charged a commission of 1.5 US cents per share. So it's fixed per share at 1.5 US cents. Then the trading hours are between 4:30 p.m. up to around 11 p.m. Kenyan time. So those are the only, or that is the period within which the shares are available for you to trade. Any other time, it would be impossible for you to trade US shares. Then when it comes to margin, the margin is between 5% to 100%. So it's in between there. So when you talk of margin, it's the percentage of capital that would be required to open a position. Then other stocks or other companies that traders can be able to trade are European companies, so they're around 22. And we also have UK companies, which are around 36 in number. So the minimum for these companies, or the minimum contract for which you can own European companies or UK companies, is a minimum of 1 share, then a maximum of 300 shares per contract. Then the commission for these stocks is 0.16% per share, only when you're opening the trade. Then the trading hours are between 10 a.m. Kenyan time up to around 6:30 p.m. Kenyan time. Now, how then would you calculate commission? So for US shares, the commission is equals to the number of shares that you decide to buy times the commission in US dollars. So we say that the commission is 1.5 cents, 1.5 US cents per share. So if, for example, you've bought 50 Amazon shares, you'll multiply 50 by 1.5 US cents to be able to know the amount of commission that you will pay. So for this particular example, you'd end up paying 75 US cents for that contract of 50 shares. When it comes to EU and UK shares, if, for example, you are to buy 50 shares of Rolls-Royce, where the price is 350 pence, you'd be able to know the commission by taking the basis points multiplied by the trade value. So in this case, the trade value would be 50 shares multiplied by the cost of each share, which is 310 pence. So you'd end up spending 15,500 pence, which is equivalent to 155 pounds. Then you'd multiply that cost by 0.16%. So you take 155 times 0.0016, which is the same as 0.16 divided by 100. And then once you multiply by 155, you should be able to get around 25 pence. So it would cost you around 25 pence for that contract. Then when it comes to dividends, dividends are a portion of the company's profit that is that the company chooses to return back to the shareholders. So once a company makes profit or part of the retained earnings of profit of the previous years, that money can be, or a portion of that money can be distributed back to the people who hold shares in that company. Of course, depending with the amount of shares that you have. So you'd be given X dividend per share. So they allow shareholders to earn money from an investment without having to sell their shares. So this is an additional source of income for the shareholder, besides holding shares, hoping that the value of the share would change in the favor of the shareholder. So one way to make money through shares is through capital gains. So capital gains is when the price changes in favor of the trader or the investor. So once the share value, once the share gains value, that is called capital gains. Then the other way to earn is through dividends, which is part of the profits that the company makes. So typically, it's paid quarterly or annually. Occasionally, there are cases where you'd have special dividends, more so when the company does quite well. Then the other thing is that when dividends are announced by a company, its share price tends to rise in anticipation that the dividends will be given in the near future. However, once the dividend is paid up, the share price is likely to decline. So dividends are subject to different tax laws, depending, of course, with the country in question. So for example, if you take US, for US stocks, it attracts a tax of 30% for the US stocks. So we'll now jump into the trading platform just to have a look at where you'd be able to get these stocks. So when you open your trading platform, so this is MT5, you need to ensure that the market watch is turned on. So you'd go to view, then you ensure that you have selected market watch. Then on the market watch section, you'll be able to get different categories of assets. So for example, if you want to trade Apple shares, you'll just click on the Apple share and drag it on the chart. So like for today, or at the currently the price is at $196. So we said that the minimum number of shares that one can buy is one share. So in this case, if you are to buy one share of Apple, you'd require $196. However, due to the fact that you would trade contracts for difference on our platforms, and we say that the leverage would be anywhere between 5%. Rather, the margin would be anywhere between 5% up to around 100%. If let's say the margin requirement for Apple stock is 5%, so instead of spending 196, or instead of having a margin of 196 for one stock of Apple, then you'd only require to set aside 5% of 196, which is around $9.80 to own one share of Apple. And that is the beauty of leverage. Instead of allocating a large portion of your capital, a high leverage tends to reduce the amount of margin or the amount of capital that would be required to be set aside to enable you to open a trade. Then if you wanted to open a position, you'd go to tools, then you click new order, then you ensure that the symbol of Apple is the one that is available on the first slot, the symbol. Then it's market execution. Of course, you have to ensure that it's within the time frames that we mentioned. So around 4 to 11 p.m. Kenyan time. Then the list is one share. Then you can proceed to set a stop loss and take profit. So let's say you can decide to set your stop loss at 190. Then once you set your stop loss and take profit, you can click buy. The alternative would be to execute the trade first. Then you click your entry price and drag. So you drag up to where you'd want to have your stop loss. Then again, you drag and set your target or the take profit. And there you have it. So it's just a matter of time. And once you do that, you can be able to track the performance of your stock on the trade option. So when you go to the toolbox under trade option, you can be able to see how the performance is. So basically, that is how you trade stocks. So we'll stop there for today. And I look forward to interacting with you tomorrow. So we'll have our final session tomorrow at 9 p.m. So enjoy the rest of your evening.